$2.7 trillion silently repositioned. Not hundreds of millions, not billions. Trillions with a capital T shifted from Q2 2025 into January 2026. While mainstream media blasted soft landing achieved across every screen, while financial networks looped inflation conquered and recession dodged on endless rotation, while the entire Wall Street establishment behaved as though we'd arrived at maximum stability, maximum certainty, maximum prosperity, the largest wave of that repositioning occurred in December 2025, the exact month equity markets hit record peaks. That timing wasn't random. That was institutional capital methodically rotating while retail investors cheered the scoreboard. Because this precise type of silent repositioning has materialized before, twice in recent history with identical cadence. 1928, roughly 12 months ahead of the Great Depression. 2007, approximately 18 months before the global financial crisis escalated from under control to devastating. Identical pattern, public euphoria, private defensive positioning, identical delay, the informed move first, the masses understand later, and at this moment we've just completed month 9 of stage 3. Here's what the crowd overlooks. The financial system doesn't implode randomly. It doesn't fracture due to chance or some unpredictable black swan event nobody could foresee. It follows a blueprint, 4 stages so methodical, so replicable, so mathematically precise that once you recognize it, you can never ignore it again. The players change, the securities change, the narratives change, the framework doesn't. Stage 1 represents accumulation. Financial institutions and banks discreetly construct enormous positions in whatever's performing, whatever's expanding, whatever appears unstoppable. They don't simply participate, they manufacture the market, they finance it, they amplify it. During the 1920s, it was industrial expansion and consumer lending. In the 2000s, it was mortgage-backed instruments and housing leverage. In the early 2020s, it was commercial property, regional banking exposure, and long-dated government bonds. Stage 1 concludes when exposure becomes mainstream, leverage becomes normalized, and the marginal purchaser transitions from institutions to everyday investors. Stage 2 represents peak optimism. This is when conditions look flawless. Markets printing all-time records, media declaring triumph, economists proclaiming success, government figures claiming credit. The public accepts the system has been perfected, that this cycle is unique. The Roaring '20s, the mid-2000s real estate explosion, the post-pandemic rebound where inflation was tamed and downturn was prevented. Stage 2 finishes when optimism becomes universal consensus and caution feels pointless. Stage 3 represents the invisible withdrawal, and it's the critical phase, the one that distinguishes those who comprehend the cycle from those who become casualties of it. While the mainstream story remains bullish, institutional capital methodically shifts to protection. Not immediately, not publicly announced. Progressively, strategically, employing mechanisms the typical person never observes. They reduce credit exposure. They compress duration. They elevate liquidity. They increase cash reserves. They establish hedges. They purchase protection. The movement is enormous, yet invisible unless you understand precisely where to monitor. Stage 4 arrives when breakdown becomes undeniable. Credit channels lock up, liquidity vanishes, forced liquidations commence, defaults multiply, assets perceived as secure experience violent drops. The narrative reverses instantaneously from celebration to crisis response. And by the moment mainstream consciousness grasps what's unfolding, the repositioning has already concluded. The identical institutions that silently exited now hold cash reserves, positioned to acquire what everyone else must desperately sell. That's precisely why the figure is significant. 2.7 trillion repositioned across numerous asset categories in approximately 9 months through January 2026. Trillions don't migrate accidentally. Trillions migrate because sophisticated players are preparing for what's approaching. If you want to witness how this blueprint completes itself, hit subscribe because the coming minutes will reveal what insiders have observed previously, what current indicators suggest, and what it signifies for anyone holding assets within a system already transforming. Let's begin where this pattern genuinely originated, early 1928, the U.S. equity market at unprecedented heights, the Dow climbing relentlessly upward, economic confidence universal, Major publications promoting narratives of perpetual prosperity. President Calvin Coolidge proclaiming the business of America is business, and business is thriving. Everyone's purchasing equities. Barbers dispensing investment counsel. Shoeshine workers discussing their holdings. The entire nation convinced they'd unlocked the formula for infinite wealth. But from January through September 1928, while the public flooded money into markets, the system's architects were discreetly minimizing exposure, the established dynasties, the connected money, the informed players. They reduced positions before the crowd sensed any chill. Joseph P. Kennedy, future president's father, departed the market and delivered the observation that resonates to this day. When the shoeshine boy begins offering stock tips, it's time to exit. Insiders recognized the pattern. The public saw potential. Mainstream publications didn't feature insider departures. They featured optimism. Then you encounter the quintessential peak confidence rhetoric right near the summit. Economist Irving Fisher proclaimed in late 1929 that equities had achieved what appeared to be a permanently high plateau, confidence at absolute maximum. September 3, 1929, the Dow peaks at 300 and instead in 81.17, then stage 4 materializes. October 24th, Black Thursday, a savage decline. October 29th, Black Tuesday, another cascade of panic. Margin calls, forced liquidations, brokerages imploding. By late 1929, the market has dropped dramatically. By 1932, the Dow plummets to approximately 41, down nearly 90% from its zenith. Fortunes vaporized, savings obliterated, breadlines, suicides, the Great Depression. But here's what conventional education omits. The early movers didn't merely survive. They positioned themselves, they waited, and then they purchased the devastation. The fortunes that departed early possessed liquidity when everyone else possessed terror. They acquired oil companies, banking institutions, real estate, and blue-chip enterprises at fractions of previous valuations. Rockefeller Center was constructed during the Depression, financed by capital that had been sheltered earlier. Institutions that preserved liquidity survived, consolidated, and expanded. The masses that trusted permanently high plateau language were eliminated. The capital that relocated early became the century's premier buyer. Identical pattern, identical euphoria, identical quiet departures, identical consequences for the crowd arriving last. Now, advance to the 2000s. Q1 2006, U.S. housing at its apex. Valuations surged dramatically over 5 years, subprime origination exploding, anyone with a heartbeat obtaining a mortgage. Wall Street bundling those mortgages into securities, dividing them into tranches, constructing CDOs, and distributing them globally. Rating agencies stamping them AAA as if they were the planet's safest holdings. The system appeared indestructible because stage 2 invariably appears indestructible. But from 2006 into 2007, while the public still celebrated and the narrative remained composed, the largest capital pools began repositioning. Goldman Sachs represents one of the most documented examples. Publicly, their distribution apparatus continued promoting structured instruments. Privately, their positioning turned defensive. Banks trimmed exposure discreetly. Risk officers compressed duration. Hedges were implemented. You didn't observe it on financial television because it didn't arrive with announcements. You discovered it later, concealed in regulatory submissions and disclosures, characterized as risk management and portfolio optimization. Summer 2007, the first visible fracture. Bear Stearns announces 2 hedge funds connected to subprime have collapsed. Analysts appear on television claiming it's isolated. The system remains sound. August 2007. BNP Paribas freezes withdrawals from funds because they cannot value the mortgage instruments. Nobody comprehends what anything is worth. The market trembles, then reassures itself. The Federal Reserve will manage it. March 2008. The Federal Reserve isn't projecting a recession. The public remains calm. Then September 15, 2008, Lehman Brothers files bankruptcy. The cascade initiates. AIG requires emergency intervention. Washington Mutual collapses. Markets lose trillions. Housing drops violently. Unemployment spikes. Stage 4 becomes unmistakable. And by then, the repositioning has already concluded. And those who perceived it early, they didn't just survive, they became legendary. Michael Burry endured criticism for years, then generated billions. John Paulson constructed one of Wall Street's greatest paydays, wagering against subprime. The major banks that repositioned early emerged stronger, purchasing what everyone else was compelled to liquidate. Identical playbook. Identical delay between insider action and public awareness. Now apply that framework to the present moment. January 2025 into early 2026. The narrative solidifies. Soft landing accomplished. Inflation defeated. Recession prevented. Markets advancing to fresh peaks. The tone becomes celebratory. The message becomes, the Fed achieved the impossible. Economists praise the execution. Politicians claim success. The public becomes complacent. And during those identical months, Q2 2025 through January 2026, the assertion is that $2.7 trillion silently repositioned away from the precise exposure points that rupture when stage 4 materializes. Commercial property exposure, regional banking risk, long-duration government securities, not because institutions are pursuing marginal additional yield, but because they're prioritizing liquidity, resilience, and flexibility. Here's what that translates to in straightforward terms. In this narrative, JP Morgan Chase exits approximately $840 billion of commercial real estate exposure, office buildings, retail properties, multifamily units, reduces regional banking exposure by around $230 billion, and transfers about $340 billion from 10-year treasuries into 90-day bills. That's the indicator. It's not a return optimization play, it's a liquidity optimization play. A 10-year bond locks capital. A 90-day bill returns capital quickly. During a credit event, return of capital matters more than return on capital. In this narrative, Goldman Sachs liquidates roughly $520 billion in long-duration positions. Corporate debt, mortgage-linked instruments, emerging market obligations, anything that immobilizes capital for extended periods. Cash transitions from idle weight to strategic arsenal because cash is what enables survival during volatility and enables acquisition when forced selling materializes. The narrative also indicates their precious metals and commodity hedges increase, not because gold is thrilling, but because gold provides insurance against currency erosion and systemic pressure. And in this narrative, Bank of America diminishes mortgage-backed securities exposure by hundreds of billions, contracts portions of its commercial lending portfolio, and compresses Treasury duration toward the shortest profile on record, targeting maturities that conclude within 6 months or less. Again, compress duration, minimize credit exposure, maximize liquidity. Now, how does this occur discreetly? They don't broadcast it. They don't conduct press briefings. They employ derivatives, interest rate swaps, options, hedges. So the exterior appears neutral, even while risk is being systematically removed underneath. They scale out across quarters, 5% here, 7% there. So regulators and media can characterize it as routine and continue forward. They relocate assets through structures and internal rebalancing that sounds like accounting adjustments, not alarm signals. And by the moment it becomes visible in quarterly disclosures, it's already completed. That's stage 3. The narrative maintains optimism while the capital turns defensive. Now examine the stress indicators that make this stage 3 narrative compelling. Commercial real estate faces a maturity cliff. One frequently cited estimate, approximately $2.1 trillion in commercial real estate debt maturing between 2025 and 2027. That's office towers, shopping centers, apartment buildings, financed in a low-rate environment, now attempting to refinance debt at rates potentially 2 or 3 times the original terms. That's not a minor recalibration. It determines whether a property can generate positive cash flow whatsoever. If sufficient properties cannot refinance cleanly, defaults don't require universality. They merely need to concentrate enough to constrict credit and generate losses. Regional banks frequently become the initial domino because they maintain closer proximity to local commercial real estate portfolios and possess less operational flexibility than the largest institutions. They cannot all silently exit. They cannot all hedge at institutional scale. They ultimately hold the exposure when liquidity evaporates and confidence wavers. And if you experience the banking stress in 2023, you already understand how rapidly deposit flight can materialize once the narrative fractures. Then you have the yield curve. The 2-year Treasury exceeding the 10-year Treasury for extended duration represents a classic stress indicator because it reflects restrictive monetary conditions and cautious expansion expectations. In this script's framing, the inversion has persisted approximately 18 months. The significance isn't that it predicts perfectly, it's that prolonged inversions compress the credit mechanism. Banks borrow short-term and lend long-term. When that differential inverts, the motivation to originate credit collapses, lending criteria tighten, and the system becomes increasingly fragile the longer it persists. You can also monitor where institutions seek refuge. The overnight reverse repo facility is frequently cited as a destination where large capital parks cash when maximum safety is desired. In this script's framing, roughly $1.2 trillion positioned there is interpreted as a warning signal. Institutions are accepting minimal returns to circumvent risk. Capital is selecting safety over opportunity. And then there's the debt arithmetic. National debt to GDP approaching 120%. Real interest rates still negative in the sense that official yields don't completely compensate for actual cost inflation. Corporate refinancing obligations, often cited as roughly $5 trillion of corporate debt requiring refinancing between 2025 and 2027, rolling from low-rate financing into elevated-rate reality. If debt service payments increase sufficiently, defaults concentrate. If defaults concentrate, lenders withdraw. If lenders withdraw, expansion decelerates. This is how Stage 4 constructs itself, not with one isolated event, but through a chain reaction. Now chart the chronology to the 4 stages. Stage 1, 2021 to 2023. Accumulation in an environment of stimulus, inexpensive capital, and plentiful liquidity. Banks and institutions accumulated positions while the system was saturated with cash. Stage 2, 2023 to 2024. Peak optimism, markets rally, inflation moderates, and the soft landing narrative becomes predominant. Stage 3, 2025 through January 2026. Invisible withdrawal, incremental repositioning, defensive orientation, liquidity preference. That's our current location. Stage 4, breakdown becomes undeniable, isn't mysterious. It's simply the moment the public can no longer dismiss what insiders already positioned for. In this pattern interpretation, some analysts project the obvious phase could manifest in late 2026, perhaps Q3 to Q4. But the precise timing isn't the critical element. The critical element is that Stage 4 invariably feels abrupt to the masses because they didn't observe Stage 3. If you want to identify what typically breaks first, it's rarely the equity chart, it's the infrastructure. Credit spreads expanding, delinquencies climbing, bank lending standards contracting, commercial mortgage stress appearing in refinancing failures, and liquidity disappearing in markets that previously felt deep. That's where the warning resides, and that's why the repositioning occurs silently before the headlines transform. Every cycle, identical phrases get recycled. 1929, permanently high plateau. 2007, housing cannot decline nationally. 2025, the Fed possesses superior tools now. AI productivity will resolve everything. Debt is irrelevant. This cycle is unique. Narratives adapt with each era, but the underlying mathematics doesn't accommodate narratives. When debt obligations rise and refinancing expenses increase, cash flows experience compression. When liquidity contracts, leverage becomes precarious. When institutions compress duration and elevate cash, they're manufacturing optionality. They're positioning to become purchasers later. That doesn't guarantee catastrophe arrives on a predetermined date. It signifies the probability distribution transforms. The downside tail becomes substantially larger, and those who disregard it discover belatedly that risk was never eliminated. It was postponed. So what does Stage 4 characteristically resemble? It initiates with something characterized as contained. One credit segment explodes. One real estate category deteriorates. One default cluster spikes. Then spreads expand. Lenders retreat. Liquidity becomes discriminating. Fragile balance sheets become exposed. Forced sellers materialize. And once forced selling commences, valuations don't decline because everyone suddenly agrees they should. They decline because someone must sell immediately at whatever bid still exists. That's why the early movers prevail. They don't require predicting the catalyst. They simply require being liquid when the catalyst materializes. In 1928, those who relocated early became purchasers during 1930-1932. In 2007, those who hedged early became purchasers in 2009. In this narrative, we're 9 months into the movement as of January 2026, and the opportunity window remains open, but it's narrowing. So you possess two alternatives. Alternative 1. Accept the headlines, trust the victory declarations, and presume stability is permanent. Alternative 2. Comprehend the pattern, monitor where liquidity is migrating, and position like someone who acknowledges cycles exist. That doesn't signify panic. It doesn't signify perpetual cash holdings. It signifies you manage duration, leverage, and downside exposure like the environment can transform rapidly, because it can. And if you're questioning why this matters, even if markets are at peaks, that's literally what stage 2 resembles. The celebration is integral to the cycle. The quiet departure is integral to the cycle. The public invariably receives the warning last, and the subsequent 6 to 12 months don't require resembling the previous 3 years. Not if this pattern continues executing as it has historically. If you want the wealth-building blueprint, exclusive weekly investment alerts for high-potential opportunities, and a framework to learn to expand your financial position with more intelligent positioning, it's in the pinned comment. Subscribe, activate notifications, and I'll see you in the following video where we dissect precisely what stage 4 resembles when it materializes and how to prepare before it becomes obvious. The pattern doesn't care about your beliefs. It doesn't care about your timeline. It doesn't care about the narratives we tell ourselves to feel secure. The pattern simply executes methodically, mathematically, mercilessly, the way it has twice before in modern financial history. And right now, with $2.7 trillion already repositioned, with 9 months of stage 3 already complete, with every structural indicator flashing the same signals that preceded 1929 and 2008, the question isn't whether you believe this could happen. The question is whether you'll recognize what's already happening before recognition becomes expensive. Because in every cycle, there are two groups, those who understand the stages and position accordingly, and those who trust the headlines until stage 4 makes the truth undeniable. The former group builds generational wealth buying what the latter group is forced to sell. Which group you belong to in the next 12 months will likely determine your financial trajectory for the next decade. The clock is running, the pattern is executing, and the institutions have already made their choice. Now it's your turn.